It has been a rollercoaster year for US indices, with the S&P 500 reaching all-time highs until February, before shedding around 35% of its value from peak to trough to March, and then managing to recover more quickly than many had anticipating, hitting all-time highs once again in the fourth quarter. So where next for US and global indices in 2021? Joining me to discuss is Bob Iaccino. He's the co-founder and host at PureXposure Growth Series and the co-portfolio manager at the stock think tank. Bob, great to chat to you. Now, before we get into 2021, let's just talk about the year that's just been. What did you make of sort of the pace of recovery, particularly for the major averages stateside?
Well, hi, Victoria. It's good to see you again. I think, first of all, it was a bit much. I mean, I struggle to believe that the equity markets should be higher than they were pre-pandemic. If you were to base it just on traditional valuation metrics, which clearly that's not what anyone is doing. So I've never been one to look at the markets as wrong, and I'm not saying that now either. It's just difficult for me to follow the indices, again, being at higher levels than they were pre-pandemic when we had a 4% unemployment rate, and now we're sitting at 9.8 million people in the US unemployed, with probably a full 60% of those struggling to get back to work, even when we return fully to normal. That equity should be here. Having said that, they're being valued differently. So we are about 60% invested in the equity markets. That's about as excited as I can get about the levels here.
Yeah, I mean, it's interesting that you talk about it in terms of what we're seeing right now, because there just appears to be so much about this narrative that, US equities, global equities are pricing in the outlook for future growth and sort of justifying it that way. So in a sense, you're implying that equity markets look overvalued. What does that then mean for what we see in terms of price action in 2021?
Well, I think overvalued tends to be relative every time we use the term. Same as undervalued. I mean, overvalued versus what? If classic valuations are gone, then clearly we're fairly priced. But to me, again, when you look at the end of the day, what companies are going to survive in their current form and which ones aren't? And there's a broad swath of, especially the Russell 2000, but the S&P as well, of companies that will look completely different at the end of 2021. As you've noted in the past, 2020's pandemic has accelerated tech migration, which I think accelerates permanent job losses rather than just furloughs, not just in the services industry. So when you're looking at it from that perspective, I think they are overvalued by any measure. Having said that, will be the types of investors to buy dips when they happen, simply because you are looking at a permanent, I shouldn't say permanent, but at least in the short term, a bid to the market that isn't likely to go away from the perspective of central bank liquidity, fiscal spending, and then a new generation of people that have discovered the stock market while being furloughed. Even when they go back to work, if they haven't already, I don't think they completely abandon it. So there's more of a permanent bid to the US equity markets and equities globally than there's ever been before. And I don't think that goes away quickly. I just think there's a lesson that needs to be learned prior to us taking a leg in this bull market higher. It's already been 14 years. And I just think from a traditional perspective, there's going to be a pullback. And I think that pullback might happen as soon as January.
Wow. So in terms of sort of subsectors of the economy and the stock market, this year we've seen mega cap tech clearly outperform. How do you think that shift might change as we head into the next year?
Well, that's the rebalance that we've seen in the fourth quarter, right? I mean, mega cap tech definitely outperformed, but it seemed like the broader optimism came when, let's just use the Russell 2000 as an example. When the Russell 2000 started to catch up and outperform is when you really saw optimism that I would say could be longer lasting, because that theoretically represents the broader market. Typically, the Russell 2000 will outperform the other three indices, all else equal. And that's just simply a matter of, if you have a 16-year-old child and a 12-year-old child, and the 16-year-old child's gone through a growth spurt, who would you bet would grow by more inches the next year? You'd bet it would be the younger child. And that's sort of the representation of the Russell 2000. You have smaller companies that have theoretically more room for growth. Are we going to get more companies that go from 500 billion to $1 trillion? Or are we going to get more companies that go from 10 million to 100 million? I would say it's the latter. Having said that, I think that's probably where we might suffer early in the year next year. And a lot of it has to do with, again, 60% of companies potentially being out of business in the services industry, maybe about 30% of companies broadly potentially being permanently closed. That's likely to hit the Russell harder than anything else. And we won't know what that's like until fiscal is passed and then ends. And that's somewhere probably at the end of the first quarter, beginning of the second quarter.
Okay, so what about geographically in terms of opportunities? I guess, what are your thoughts on the recovery in the US versus Europe, and what might that mean for the performance of, say, the DAX or the FTSE versus the US averages?
Well, oddly enough, I'm a big fan of the FTSE right now. I think the FTSE easily has 10% more in it. So that's really somewhere that I'm kind of got my focus on, because I think that triggered a couple of weeks ago from the way that I look at the markets, is that once we get past EU Brexit in whatever form, I think that's held a cap. I also think there's a lot of pent up demand in the UK that's been struggling, not just with the pandemic, but with the Brexit trade situation. That's been sort of an anvil on the UK prior to the pandemic. And if we can lift both of those at the same time, I think there's a potential short-term explosion in the UK. US versus EU, I think I prefer the US simply because it's a simpler calculation for me. I think the dollar is going to stay weak. But I think at some point when the snapback happens, there'll be some point in time where the UK, Japan, the EU, even China does not like the weaker dollar and starts to sort of combat it with their own policies. And I think that's going to skew me a little bit more toward the EU at that time. But I'm a little bit concerned with the weakness of the dollar and how quickly it's accelerated. So for me as a US investor, that'll always have me leaning toward the US. I think the UK has so much pent up growth in it from an equity market perspective that I think it trumps all the other factors.
Yeah, so you mentioned that China might not be too keen on continued dollar weakness if that comes about. In terms of opportunities in Asia, which indices are you most drawn to as we head into 2021?
Well, I'm probably not, to be honest. Again, I think that when you're looking at Asia, it's a lot more complex of a story. There's the issue of what is the Biden administration going to look like toward China? And we know that a tighter grip on China has been a bipartisan issue for 4 to 6 years in the U.S. And President-elect Biden has already said that he's not ready to abandon the phase one trade deal. And President Trump, with all his faults, I think exposed a little bit of bend in China's stance on things. And I think in order to be the centrist that I believe he was elected to be, Joe Biden might be a little tougher on China than people think. So I'm not really keen on China at all. So again, I think I would probably stick to Western indices at this point, strictly UK and the US. It would be something. I would be interested in Japan, but I'm just not sure about the catalyst for Japan. China, I think I probably want to completely avoid.
All right, Bob, it's been great chatting to you. Thank you so much for all of your analysis, as always. And that was Bob Iaccino. He's the co-founder and host at PureXposure Growth Series and the co-portfolio manager at the Stock Think Tank, joining us to discuss the outlook for indices in 2021. I'm Victoria Scholar, and we'll see you very soon. For more videos like these, subscribe to our YouTube channel, IG UK, and make sure to follow us on Twitter. We're at IGTV.